Are you ready to file your federal taxes? Here's a quick crash course to help you prepare. The tax submission deadline, or so-called tax day, is always April 15th unless it falls on a weekend or legal holiday. Then it's simply the next business day. Tax day is also the deadline to submit for a 6-month filing extension. However, you must still pay any estimated taxes owed by that day. It is also the last day to make any final contributions to a qualified retirement account, such as a Roth IRA, or to other tax advantage products like a health savings account. Whether you choose to file on your own, use tax prep software, or employ the services of a human to do your taxes, you'll have to first obtain all of your tax documents. The most common form, and the only form for many Americans, is a W-2, which is a record from your employer showing how much you were paid, how much was withheld for taxes, and other pertinent deductions. Fun fact, the IRS mandates all employers send out W-2s no later than January 31st. The two other tax forms most Americans will receive are a 1098 and a 1099. The 1098 is for things paid or given, such as interest on a mortgage or student loans, while the 1099 is for things received but not taxed in that moment, such as interest on a savings account or some of those side hustle paychecks. Now that you know your deadlines and have your documents showing your total taxable income, it's time to make a choice. Well, sort of. Take the standard deduction or go itemized. I say sort of because the 2017 Tax Cuts and Jobs Act made this much less of a choice by nearly doubling the standard deduction from $6,500 to $12,000 in 2018 for individuals, twice as much for joint returns, of course, and those go up every year to keep up with inflation. That same legislation also eliminated or restricted many previously itemized deductions. So for a vast majority of Americans, standard is the better option. Regardless, this figure will take that total taxable income and reduce it. Let's say that you're a single filer with $100,000 of taxable income and you go standard deduction. First of all, congrats on your success. Now subtract that 2018 figure of $12,000 from $100,000, and at this point, you're only paying taxes on $88,000 of income. You have it. Oh, you're still watching. All right, well, for those of you still with me, I've got a little bonus tax education to toss your way. Maybe you've heard of tax brackets, which dictate what percentage of tax you owe based on your income. Well, one thing that was never quite explained to young Chip Brewster was the fact that they are progressive, what that means, and how it works. So allow me to enlighten if you too are in need of knowledge. As of the making of this video, there are 7 federal income tax rates: 10, 12, 22, 24, 32, 35, and 37%. Each has an amount of income associated with it. For easy math's sake, let's say it's increments of $20,000, which it absolutely is not. Google that one for current amounts. Okay, great. So bracket 1 is 0 to 20,000. Bracket 2 is $20,001 to $40,000, etc. You've got a tax rate and a dollar figure for each bracket. As you earn more, you are taxed more. However, and this is the part young Chip didn't understand, that tax rate is only for the dollar figure within that bracket. So in this example, regardless of your total income for the year, you are only going to pay 10% tax on the first $20,000. Then for every dollar earned between $20,000 and $40,000, you are taxed at 12%. In other words, when you cross that line into a new tax bracket, everything you earn is not suddenly taxed at a higher rate. Only those dollars earned in that bracket. Well, that is my super basic crash course on taxes. Taxes as a whole, though, can be far more complicated. Fortunately, there are many free programs out there to not only educate, but assist in tax preparation. Even the mighty Internal Revenue Service has just such a program. Find one and reach out should you have any questions. Happy tax season, everyone.